At the end of this video, you should be able to identify when the trend is changing or when price is going to reverse, when price gets to a key level. So we are going to be sharing with you 3 examples. We are currently on gold on the 4-hour and the 1-hour time frame. So this is the level we have drawn. This is our support level, which was broken. So we expect a pullback to the retest area, to where the level was broken, to get a retest before a continuation down, because that's how the market moves. But currently we are not getting that retest, and price start creating levels. Price created a level. These 4-hour candles, you can identify multiple week rejection. So what you want to be doing is marking out that level. We'll mark out that level, mark out the level like this. Since we are not getting a retest, the next step we take is to mark out the level. These are 4-hour candles, so mark out the level like that. Mark out the level, this level from the 4-hour time frame where price has been trading below. Price is not breaking above the level. That was why we mark out the level. So when we scale down to the 1-hour time frame, you can see price created an area. And what do we see in that area? We can identify multiple week rejection. We have several week rejection. Whenever price got to the level, we see a weak rejection and price continue down. So this becomes our key level, not the retest area. The only time we'll start considering price getting here is when price violates this level we have drawn and price broke above. Then the next level will be the retest area we expect price to get back to. So once at this area, the next phase is to scale down to our entry time frame, which is a 15 minutes time frame. I personally use, but you can use the 5 minutes or the 1 minute, but I personally use the 15 minutes time frame. So let's scale down to that. Let's scale down to the 15 minutes. So on the 15 minutes time frame, things get more clearly here. You can see weak rejection. Let's say we're waiting for price to get back to the level here, but price currently didn't get to the level, and we start identifying weak rejections when price get back to that level, that key level. But on this example, price didn't get back fully to the level, but it did here and here. But just to use this as for example, you can see we have 2 weak rejections. Price got to the level and pull back. We have a pullback, price close with a weak rejection. So this is indicating bearish momentum around the level. So once we get this 2 week rejection, we can take the trade. I don't know how you take the trade, but you can set the sell stop order below the candles. Below the candles, you can set sell stop around the level here, and your stop loss above the wick or above the level. So I don't know your entry techniques. You can take an instant execution, but since price is not currently at the key level, if price was at the key level and we got this weak rejection, we could have taken an instant execution, and our stop loss will be above the level here. But price is currently hasn't got to the level, and price is turning bearish. The trend is price is going down. So we can enter this and place our stop loss above the wicks. But your safest stop loss is going to be above the key level here we have drawn. So that's how you identify how the trend or price is going to change at key levels. And if you scale down further to the 5 minutes, you see it more clearly. You can see multiple weak rejections, multiple weak around the area. So you can just set your sell stop order below some of the open candles, and price will just keep going down. So that's the first example. Let's move on to the next. So the next example is on US oil, currently on the 4-hour time frame. And remember, the first thing you need to be doing when you come to your charts is to mark out your key levels using the 4-hour time frame. So we'll mark out our resistance area. The reason for marking this level is We identify multiple weak rejections there. Whenever price got to the level, it left a weak rejection. So we can identify this as a resistance area. Price is not breaking above that level. After marking our resistance area, we can mark out our support, which is the same thing. Price is not breaking below, and it leaves weak rejection whenever it got to the level. So we'll mark out our supports like this. We want to account for as many weak rejections as possible. So mark out our support like this. So we have marked out our supports and resistance area. So the next thing we want to be doing, and what do we see? Price is moving sideways. Price is not breaking above or below the level. Remember, the trend is down, and after a push phase, we anticipate a pullback, then a continuation. But price has been moving sideways. Price hasn't given us a continuation or lower low. We expected a lower low to form after the pullback. We expect a lower low because that's how the downtrend works. But currently we are consolidating from over 14 hours here. So currently this candle is pushing below the level. We are currently having a break of that level. So the next thing we want to do is to scale down to our 1 hour time frame to see the behavior of the candle. So we are currently on the 1 hour time frame on the right. So we're on the 1 hour time frame on the right, and this is a strong bearish candle, but we still want to get a cleaner break. We still want this candle to push down to give us a clean break of that level in accordance with the overall trend of the market, which is down, to get a continuation down. So what I want to highlight here, let's not digress. What I want to show you guys is how to identify trend change. Remember, the price was moving sideways for a while, and whenever price got to this resistance area we have drawn, this level here, you can see multiple weak rejections. So this is what you need to be looking for. Let me scale down to the 15 minutes. So this is what you want to be looking for. You want to be looking for multiple weak rejection, not just one weak rejection, at least 2 or 3 weak rejection around the level, and set a sell stop order. That's if you are selling the market, use a sell stop order. The reason for that is if you take an instant sell, price might push up and create a weak rejection above. Price might still close below the level into the range, but the weak area is going to stop you out before price going down. So that's why whenever you are taking a reversal, or if you anticipate a reversal, you shouldn't be the first to take the sell. Wait for at least 2 weak rejection in the direction you want to be taking the trade, which in this case, this 2 week rejection is down. So you can set a sell stop order below some of the open candle. Let's say we were live at that time. I'll set my stop loss below this bullish candle and my stop loss above the level. But if you are taking trades here, you can simply place your stop loss above the key level. This is going to be your safest stop loss. But if the momentum already kicking and price is already pushing down, then you can set your sell stop here, because you are going to be entering with momentum. So price is going to push down, so you can set your stop loss above the weak areas. So that's how you identify reversals or trend change. Hope the video was helpful. If you have any question, drop it in the comment section below. And if you haven't subscribed, subscribe to the channel, give us a thumbs up, and see you at the top.